Joining us now is Ken Leon from CFRA to talk more about what to make of these numbers, Ken. And specifically when it comes to Goldman Sachs, it seems as if the provisions for potential credit losses in the consumer lending area, as well as maybe just higher expenses that went along with what we already knew about weakness in investment banking, causing some people to really kind of throw in the towel on the stock today. Do you think that's a justified reaction?
So Goldman disappointed, and I think looking out to 2023, do they have the right strategy, or this is a management that has a work in progress, particularly with that expansive effort into consumer retail banking? That has been pulled back. They didn't take any large write-offs, but there's questions. You know, it's tough to stay just in the investment banking space. And that will come back when we get to a risk-on environment, but that's not going to be for the next 6 months. So they have an investor day at the end of February, and there's going to be more information about what is Goldman's strategy looking at over the intermediate or long term.
And the reaction of Goldman, especially in contrast with Morgan Stanley, is pretty stark. But, you know, Morgan Stanley had already built up a pretty sizable valuation advantage over Goldman, meaning it's obviously got a higher valuation. People very much approve of the steadier wealth management orientation of Morgan Stanley. Again, I just go back to this split in terms of Morgan Stanley probably has never looked this expensive relative to Goldman Sachs, at least not in a number of years. And I wonder if you think, again, that the market is reading this correctly.
Yeah, Mike, so we've had these discussions before on air, and really James Gorman has put a strategy to get a higher multiple, more akin to a BlackRock or Charles Schwab, with sizable wealth management and asset management for recurring revenue. That still has opportunity on the upside because it's trading below the S&P 500, and Goldman is 1 or 2 steps behind there. David Solomon at Goldman, he's just going to have to grow, not organically, but by acquisition, more assets under management, and that's really the direction. You're not going to get a higher stock price for doing credit cards or retail banking. That game is really dominated by the banks that reported Friday.
And do you think that the provisions that Goldman took in the past quarter for, in part, that consumer credit card and retail banking business look sufficient? I mean, I think there's probably a sense out there that were much higher than people were anticipating. Is Goldman essentially trying to sort of front load some of the pain so that it's a cleaner outlook in subsequent quarters?
Well, there were provisions, but it's not in the billions. And we're not sure because they don't disclose operating income or loss for their segments, including the roll-up of platform solutions, which is where retail is. So we just don't know, and that's why that investor day is a tipping point for the management and for the stock. We also think, you know, when you look at Goldman, you know, they're doing great in terms of being the best investment banker, you know, but we're in a risk-off environment. And actually, it was James Gorman of Morgan Stanley said, you know, when the Fed stops raising rates, you know, maybe his stock will go up or the whole group. But it will take time because we've got higher rates, higher cost of capital. That means deals are more expensive.